My chance new girl watch made in China. We play ping pong ball made in China. Get bitch matter says.
Hello and welcome to China Econ Talk. I'm here today with Martin Chorzempa, a research fellow who recently joined the Peterson Institute of International Economics and is based in DC. He's a graduate of the Harvard Kennedy School and previously worked at the China Finance 40 Forum, a leading Beijing-based think tank. Martin, thanks so much for coming on the show.
Thanks for having me.
Before we jump into internet finance and the research you've done on this, I'm first curious if you could get a little bit of background into your China story.
I was working in Europe doing work on financial regulation and state-owned banks. And it was pretty clear that although this was the time when it seemed like Europe was driving much of what's happening in global markets because of worries about the euro crisis, it was pretty clear that for the future of finance, which I'm most interested in, China was going to be probably the most influential player going forward. So I said, hey, I really want to go understand how this works because there's a huge barrier to entry to having a clue about what's actually happening in China, including a big linguistic barrier. So I applied for a Henry Luce Foundation scholarship, got it, and then learned Chinese, worked at CCER at the Peking University for about 6 months, learning Chinese, getting familiar with finance Mandarin, and then I worked at CF40 for about a year and a half.
So do you have a favorite finance Mandarin word?
That is a good question. I would say something like 看似主义, something like that, Keynesianism.
Solid. So why finance in the first place?
Well, I grew up in a banking family. My great-grandfather started a small community bank in Minnesota. At the time, it was a more rural area of Minnesota. So I've kind of been steeped in finance for generations. And the main reason is that I see how important it is to communities and the economy. So if anyone wants to start a business, they need finance. If you want to save up for a house, just about any important decision people make in their lives is influenced by how well the financial system is working. And although ideally you don't really have to see it very much, ideally it just kind of works. And there's a lot of work behind the scenes to make sure it's well regulated and the incentives work in the correct way so that everything functions really well. So I just think it's interesting and important.
So one of the most salient features of the Chinese financial universe is that half of Chinese have no credit history, which is a big impediment for folks getting loans, starting businesses, buying houses, whatever else you want to do with capital. So could you talk a little bit about how China got to this state and fell behind on this metric of where most other developed and many other developing countries are now?
Sure. Well, in a way, it's almost like it never started. So, for much of the early history of the People's Republic of China, there was only one bank. It was the People's Bank of China, and that really only functioned as as sort of like a check business in a way. It's like the plan determined by Communist Party officials determined which entities get what money, and then those funds were just dispersed in whatever amounts the plan prescribed to those places. So in that kind of environment, as you might imagine, there's no consumer credit. You can't go out to a bank and get a loan to buy a refrigerator that you can't afford yet, and there was no mortgage market because there was no private ownership of homes, really. You would get your home assigned by the work unit. And therefore, when you have a country like the U.S. where people, especially in, the 50s, 60s, were buying all sorts of things on credit and building up credit histories, China never really was able to do that because there wasn't a consumer credit market. And for a long time, even when there was a little bit of a consumer credit market and a mortgage market, when say in the 90s, some of the state-owned enterprise reforms led to there being a more of a private home ownership market, there really wasn't the kind of system in place that allowed sharing of data between financial institutions. So what's really important for making the market work is if I get a loan from Bank of China and I pay it back, and then I go later on and I get a better deal maybe from ICBC, that ICBC knows that I got a loan in the past and I paid it back, and therefore I'm probably a pretty good credit risk. They should give me a good priced loan. But if there's no sharing, then you have on the consumer side that problem. You don't have a way to prove to other lenders that you are a good credit risk. But also, if I defaulted on that Bank of China loan and I'm a bad credit risk and I come to ICBC, they might have no idea that I'm a bad credit risk unless they were able to get information from their rival. And these systems are very difficult to set up, and China's been working hard at it. The main system for this in China was set up around 2004. So they have had a much shorter history, much less time to build up these kind of credit scores compared to other countries.
So I guess it's not really fair to compare them to countries that have had capitalist systems for a few hundred years now. But do you have any sense of how Vietnam, how other second world post-communist, well, let's leave that discussion for another time, but other post-communist countries have tackled this issue?
I've read a little bit about it. That's something I would like to do moving forward in my research agenda. But I do get the sense that other countries like Vietnam are doing somewhat similar methodologies, and generally developing countries have, unlike the United States, where we have the credit bureaus that manage the information sharing, those are private companies. Often it's actually the central bank in these countries that runs the credit bureaus, and that's true for China as well. So in a way, the World Bank was very influential in advising China on how to start developing these systems, and they're following, in a way, this playbook for emerging market countries. I think other ones are broadly similar.
So could you talk a little more about the impediments? You mentioned earlier how the banks see this information as a competitive advantage and don't want to share. But what else is getting in the way of building credit history?
Sure. Well, I would first separate two different types of data to put some structure on the question. And one side is traditional borrowing histories. This is the stuff that is generally used in the United States. This is just what's your history of taking out loans and paying them back. And in China, at least for regulated financial institutions, this works pretty well. If you've actually had a credit card in China already and you've been borrowing on it, then there isn't really too much of an impediment there, because the whole legal system and regulatory system and technical systems, those have all been built up. The problem is that Chinese for so many years have been using informal credit instead of formal financial institution credit. So if you borrowed from, say, a small loan company or a peer-to-peer lender or an informal loan shark in your local area, then there's no data sharing whatsoever, partially because there's no technical system that has included many of these players together. So that's one side. That's the main reason why this financial borrowing history data isn't shared and hasn't been built up. Again, this all stems back to the fact that there hasn't been a good consumer credit market from banks for a long time in China. But then the other side is, we can say, is there a way to leapfrog and to generate credit histories and credit scores that allow you to lend more easily to people without necessarily having to wait until they've all borrowed? Because the borrowing in the first place is the hard part. If you don't have a credit history, a bank isn't going to be very excited about lending to you. And there we can potentially use all sorts of other data about you to get a sense of how good of a credit risk you are. But all this data.
So let's talk about the biggest entrant into that market, Alibaba's Sesame Credit. I just wanted to let everyone know that I clock in at a respectable 619. Not top of the line credit score, but I could be looking a lot worse. So where is Alibaba getting this number for me? And what is their vision for what this credit score can do?
Sure. So Alibaba has about they say about 5 different areas of evaluation that determine your score. These are quite vague, and it's unclear what exactly they mean. There are things like your borrowing history, which you would expect, but other things like the strength of your social network. I think it's like Renyong or something like that. And but generally, the sense I get is that this is data that Alibaba has on you. So if you use Alipay, they will look at the payments that you make in and out and maybe back out a sense of what your income is likely to be. They'll look at your purchase history on Taobao, which again might help give them an idea of how much income you have. And then if you've done any borrowing from Alibaba, then that will go in there too. You can choose to share other data with them, but generally the main crux of what they're using is Alibaba data.
So, a Black Mirror episode from last season called Nosedive, I don't know if you've caught this, but was basically a dystopia of every single person rating every interaction they encounter, and the main character starts getting an attitude and ends up getting thrown in jail because enough people give her such low ratings that she loses her house and her whole her friends, and her whole life falls apart. There's certainly an optimistic story here of these numbers being created from alternative data and then giving Chinese people the opportunity to get better rates on loans than they would have otherwise. But what's the potential dark side of using all these different data streams and giving power to private companies like this?
Yeah, so that's a really good question. There are a lot of potential downsides, mainly around privacy and potential discrimination around data. So if you think about generating a score, you said, how does Alibaba come up with this number? If you're calculating based on pretty clear financial information like someone's borrowing history, there's a pretty compelling case to say that your borrowing history shouldn't really be something that private. I mean, there's a good reason to share this among institutions because everybody overall gets a better credit market. But when you start getting into things like what your shopping history is, who you're paying, and all that gets into much more personal aspects of an individual's life, and you don't necessarily want to share that with a lender. You might begin to, if you think about the incentives for credit scoring based on traditional metrics is, you establish a history that you've borrowed before and you pay everything back. It's pretty straightforward. You demonstrate that you're a dependable person. But once they start basing it on your shopping history and the people that you interact with, then you start to say, well, do I want to interact with somebody who has a bad score? I know they're a good friend and everything, but Alibaba says they have a bad score, so maybe I don't want to be splitting bills and sending them payments because I can lower my score. And you have all sorts of incentive effects that start to look a little more worrisome. And maybe if they're tracking your location and some of these other sides, then you start to worry much more about privacy, and it becomes much more subjective. Because it's unclear when, for example, they're using these machine learning algorithms that put in a ton of data and try to generate a statistical score. It's not clear why the machine made that decision. It might be that there was some correlation at some point that was capturing something else that they didn't even realize, and then that might stick in the model for a long time, and it might actually not lead to a better score.
it's important to emphasize for listeners who maybe don't live in China just the amount of times over the course of a day you would interact with Alibaba products. So Taobao, as Martin mentioned earlier, is like a giant Amazon, where you're buying more stuff than you need. They have investments in products all, in hundreds of different companies. So every time I get on an OFO, I am, feeding data into, whether or not I'm riding a bike every single day. The amount of, data these companies have is really astounding. And, as much as Americans may be scared of Facebook knowing everything they do, there's a different level of, pervasiveness that these Chinese conglomerates can really dig into, which has good and bad sides, as you mentioned. The optimistic and the pessimistic story of these credit scores is really I think a unique development in the world.
Yes. And I would add as well that actually many of these companies, at least in the United States and also to some extent in China, that claim that they're using millions or thousands of data points and they use all sorts of buzzwords like machine learning, AI, big data, algorithm, all of these words, and they haven't actually had that great of results. So my sense after looking at this for a few years is that actually the holy grail, the best thing you can do is just base it on traditional borrowing data. And the advantage of all this alternative data and extra monitoring stuff is mainly, can you generate and give credit to people that don't have a regular borrowing history? And the goal should be you use this to develop a borrowing history that is traditional, like FICO in the United States, that's the main provider of credit scores, and then you don't really have to look at all this alternative stuff anymore. So it's like an interim stage to get you to where, say, we are in the United States for most people.
So recently there's been some domestic pushback here in China, and you with regards to the Sesame credit score, and you wrote in one of your pieces that interviews with current and former PBOC, the People's Bank of China officials, suggest that the pervasive use of the Sesame score as a proxy for trustworthiness, far beyond the intention to help in the provision of credit, is viewed as an overreach of the credit scoring authority. So often you hear the narrative in the West that Chinese people don't care about privacy. But could you delve into that question a little deeper?
Sure. So on the privacy side, what we're seeing is a change in China. There's more of a privacy consciousness than in the past, and part of this is just a result of accumulated, frauds and problems. So I'm sure you've experienced by now in China all sorts of fraudulent text messages and possibly also emails and phone calls trying to sell you wealth management products or something, and you wonder, how did they get my information? How did they get my phone number? And part of this is because companies are leaking like a sieve. These companies are leaking information and selling their clients' information for money so that they can profit from it, and then other companies then use that data to try and give you, say, pretend that they're your bank or something else. And Chinese people are just getting tired of this. And the way to get around that is hopefully to improve the privacy, so that you have to give less of your private information, say your contact information or anything else, to the companies you interact with, and that those companies, once you give it to them, will not share it with other ones. That's one side of the puzzle. And then the other side is with the regulatory authorities. And in this case, what we have is, the reason that Sesame Credit exists is that the central bank realized it was not going to be able to add much of this alternative data to its own credit bureau, and said, maybe Alibaba can help do some supplementing and improve financial inclusion. And they did the same thing with Tencent and Ping An and others. Alibaba's just been the most successful so far. And what has happened is that they wanted to use this to expand credit. but Alibaba has used it, Ant Financial, has used it far more than for credit. It's used to waive a deposit for, say, when you're checking into a hotel or renting a car, or even for a dating app or getting a visa to Singapore, all of these other things. And the Chinese government says, who gave Alibaba the authority to say whether someone is better or worse risk for a Singaporean visa or a car or something else? They said that these licenses are generally meant to deal with credit. Now, this does bring up an interesting point, which is, how pervasive credit is in the modern economy. When you might not think about it as credit when you are renting a car, but actually, in a way, they're providing you credit. They're hoping that you will return that car in the right, in a good state, that you won't crash it, that you won't steal it, that you will, if there's some sort of problem, you'll be able to pay back. And generally, in places like the United States, because we have credit cards all over the place, we don't really see many of these deposits. We just come in and you check into a hotel and they swipe your credit card. And that's there so that they don't really have to trust you. They know that if you put some charges on the room and try to run away, they can charge your credit card. But in countries like China, where credit cards are not so common, this is a much bigger problem. And China's authorities are really struggling with how to create this balance of having more seamless economic transactions through credit, but also limiting the power of private companies in being the ones who determine who's eligible for what.
So now let's turn to another one of your research focuses, the peer-to-peer lending universe in China. So what is this business and what need is it trying to fill?
Sure. The main area that this fills is what I mentioned before, this gap in the consumer credit market. In the past, if you're Chinese and you want to borrow money for either just this month your income didn't match your expenses, or you want to borrow to start a business, or you want to borrow to buy a car or something like that, there were very few options available for you. And generally the ones available through your local loan shark or something like that are going to be very high interest rate. They're going to be very expensive and low tech in a way. You got to kind of know somebody, get vouched for, and all that. And the peer-to-peer lending space came up to fill some of that enormous demand for credit that exists all throughout the Chinese economy. That's one side of it. The other side of it is the people who are providing the funds that are ending up being lent. And these are people that in the past would have been limited to very low interest rate deposits, where for much of the 2000s, you might have actually had, if you include inflation in your calculation, you have lost purchasing power if you've been saving your money. So if you saved 100 yuan in 2000 and you kept it in the bank until 2004 or 2005, you might actually have less ability to buy stuff with that 100 and whatever yuan after your interest rate at the bank than you would have in the past. So saving was a losing proposition. And the peer-to-peer lenders, the platforms that arrange the connection between people who are providing funds and people who are lending funds would give, at the same time as lending at lower rates than some of the existing players, they would return you a lot more money if you were one of the lenders on the P2P side than you would get at a bank with a wealth management product or something else. And so on both sides, they fulfilled this enormous demand to both find well-paying investments and credit.
Could you give us a brief history of the industry up until the Yizhubao development in 2015?
Sure. It began around 2006, 2007, somewhat simultaneously. It really began online in the UK. and then spread to the United States and China. In a way, peer-to-peer lending, without the internet, of course, is something that's existed in China for millennia. We have all sorts of references to individuals lending to each other, not necessarily through banks. This is a common Chinese historical practice as well. When things really began to take off was around 2013. Which is a time you might remember that Yuebao became something that Chinese people began to invest an enormous amount in, this online money market fund run by Alibaba. And my sense is that at that point, people began to trust more that they could invest money over the internet and it wasn't all going to be a scam. And that's what really led this to take off, in addition to the increasing amount of regulation on Yuebao that lowered its returns, created more demand for really high return, high risk investments like P2P lending. And then it began to grow at a couple 100% a year, maybe up to 450% a year between 2013 and 2015. And then we have Yizhubao, which although the industry continued to grow very rapidly after the Yizhubao Ponzi scheme collapsed and was in a way popped by the authorities, that's when there became a real imperative that the government needs to regulate this.
So you mentioned that in your research that there were public protests around the Yizhubao explosion. Could you talk about the story there and why this caught the government's attention in particular?
Yes. Yizhubao had reportedly around 900,000 investors. That's a staggering number. And as you might imagine, if you'd invested a lot of money in something like this, and then suddenly the government says this was all a fraud, you might have two type of reactions as an average Chinese person. One is the government should have stepped in earlier, should have prevented this, should have protected me as an investor. I was defrauded, and it's the government's fault. A lot of people like to blame the government when something goes wrong. The other reaction might be, well, if the government would not have intervened at this point, then I would have been able to pull my money out and with my big returns, and I would be okay. And so either way, whether it's blaming them for not intervening earlier or for intervening when they did, you have a large population of people who are very angry at the government and blame the government for this mess. And they probably thought that whatever response they were getting from the authorities was not enough, and they tried to organize protests. This is actually, although you don't really see much coverage of it because it's censored very quickly, this is a very common practice in China. There are a lot of protests, and it's one way to put pressure on the government so that they actually respond.
And if folks are interested in that topic, I would refer them back to a prior China Econ Talk episode with Peter Lorenzen about his research on the impact of public protests in China and how the government listens or doesn't listen to people who get upset about stuff. So following Yizhubao, you start writing, the regulation kicks in, and this concept of too big to fail starts getting into the P2P world. So could you talk about the regulatory response?
Yes, the regulatory response took quite a long time. I've actually discovered through looking at the many different types of new finance that exist in China that there's generally about a 7-year lag between the development of a new kind of internet finance technology and the actual regulatory response. This is about the rule. The rule is about 7 years, and that's about the case for peer-to-peer lending. If it started, as I said, around 2006, 2007, and the real rules begin to come out in 2015, 2016. And the main rules here are about trying to prevent fraud. Another side of it that people somewhat cynically read into it is that they don't want P2P platforms competing with the banks. So one side of the rules is you have to keep the loans really small. You're not allowed to lend enormous sums as a P2P platform to businesses or individuals. Part of that is competition with the banks, but another part of it is to say, you don't want someone like if you and I started a P2P platform and we own a company and we took all the money that we raised from other people on the P2P platform and lent it to ourselves. And had a highly concentrated risk. If we default, then the whole thing goes under. That's a quite an unstable way of setting things up. The other side was to make sure that the funds are tracked better. So they're supposed to now keep all the funds at a bank in what's called a bank custodian account. And there the bank is responsible to a great extent for making sure that the funds actually are there and exist and they're not being siphoned off by the operator of the P2P platform, so that if they try to run off with the funds that people have trusted with them to invest, that doesn't really work. The idea is to turn these guys instead of into financial intermediaries into information intermediaries, where they're mainly trying to price the loans and match borrowers and lenders rather than being a lender themselves.
Could you talk about the perverse incentives that these banks face when or that the government has to work around when trying to enforce these regulations?
Yeah, it's really tough, especially if, as what's the case in China, that the local governments end up being the main bodies regulating these things. And that is, if you are especially a less developed locality and these P2P platforms bring in capital from all over China that can be used to help develop your local economy, that's something that's highly beneficial. And the person who's bringing that money in is going to be quite influential in the community. So you have to deal with this tough trade-off. The other side is that this industry got so big so fast, reaching over $100 billion in outstanding loans in just a few years, that if you suddenly crack down really hard and you shut all these guys down, then you have enormous protests on your hands. Like the Izubao case, because people see that they're losing money, and you also create a disruption in the economy. But many of these things are Ponzi schemes. They might be zombie platforms that are probably defunct and insolvent, but are still operating and often still getting bigger. And you really don't want it to get bigger, so the eventual problem is worse. And that creates a really tough. I would not want that job, being the regulator for this industry.
When you talk to these folks, do they seem downtrodden?
Absolutely. Overworked, underpaid, underappreciated.
So one of my favorite details from your writing is talking about how there are some office buildings that now refuse to rent office space to P2P lenders, worried that they'll have protesters outside should the companies go belly up.
Yes. Yeah.
So could you talk about the consolidation of the industry?
Sure. Well, what's happened so far is the government has tried to slowly push out the firms that are not going to survive, and ultimately, I expect that from a max of from many thousands of platforms in its heyday in 2013, 2014, that slowly the number of platforms has gone down significantly, and this is a healthy thing because many of these platforms had very little technical competency. They didn't have a good way of figuring out who's a good credit risk. They spent way too much money trying to get big, and customer acquisition costs, both for finding people who are willing to lend on your platform and finding people who want to borrow from your platform is very hard. So many of the smaller players that weren't very good are failing and disappearing. At the same time, the overall amount that the industry is lending is going up, and that's because some of the more sophisticated, larger players are being successful. And the way I see it, there are going to be two kinds of firms that will be successful in the future in this market, especially as more regulation comes in and it becomes a little more difficult to just start up and operate. One is the very large general purpose guys, probably related to a larger group like Credit Ease and Lufax, which has kind of pivoted away from peer-to-peer lending, which is related to Ping An, a very large group, so they have more access to data on some of this. These kind of large guys will survive. And then also I think there's room for a good amount of P2P lenders that lend based on a specific niche. So they might really understand lending to a certain type of small business or a certain type of borrower using a certain type of collateral, and they might have a lot of specific expertise that helps them lend effectively in that market. But I think from thousands it's going to go down to probably 100 or less P2P platforms eventually.
So I want to turn to the money market funds that you mentioned earlier, Yuebao, and such, because I think this is an important aspect of the internet finance economy that folks should understand. So could you give us a bit of a taste of what's going on with Alipay and WeChat and these money market funds and how they've changed how Chinese people think about where to put their money? Yeah.
So in the past, the main place that people would put their funds would be in deposits in the bank. You get your pay and it goes right into your bank. But Alipay had this at the time before it was even Ant Financial, had this idea that you could take them. You already were using Alipay for payments, but what you had to do that is you had to take money from your bank and deposit it into your Alipay account, and then you could once the money's in your Alipay account, you could send it to other users of Alipay and maybe pay for things, say online, e-commerce purchases, and all this. So in a way, it was a separate payment system. And the problem if you're Alibaba is there's no incentive for people to keep money in these accounts. When they do, Alibaba makes money because they have they get interest on the funds that people have put in their Alibaba accounts. And one way to get people to put more money into those accounts is to pay them interest on it, as bank deposits also pay interest. And they were able to give much higher interest rates, at least initially, than what you could get from a bank, and it was much more flexible. You could use those funds to pay for things online very quickly, whereas with the interest-bearing bank accounts, you generally had to lock up the funds for a few months. And
so what were the numbers? What was the return that folks were able to get through this?
Oh, I think it was above 6% at one point. It was quite high initially. I couldn't off the top of my head tell you the specific number, but it was many times what you would get from a bank. But what happened is there was some suspicion that what are these guys investing in to be able to give you such a high return? And ultimately it was likely some pretty risky type of investments that might be more long-term investments. And the risk there is that if a lot of people take their money out at the same time, then you have all these illiquid investments that are long-term, but your liabilities are short-term, and you could have a kind of bank run scenario. And so regulators stepped in and have made them, say, hold reserves that don't really pay interest, that to be ready so that if anybody tries to take their money out, they can pay those off without having to sell long-term investments. And they've limited their ability to invest in more risky stuff, and that's made it safer, but it's also lowered the interest rate. I think the interest rate these days is probably something more like 3 or 4% per year.
So just to give folks a sense of how easy this is to use, the WeChat Pay or Alipay, which you're opening every single day to pay for stuff here, it has like a button you can click, which basically says like deposit your money in Yuebao or WeChat Pay or whatever the WeChat one is, and 40 seconds later, you can have the 100 yuan that your friend just sent you for dinner, getting a return for you, which isn't something that the West has quite figured out how to make quite as seamless. But it's really fascinating in that it's kind of raised the floor of what folks would expect for an investment.
Yeah, it's a great tool.
So now I wanna close on Bitcoin in China, and we can attack this from so many angles. But I guess the most recent development has been the relatively rapid souring of the Chinese government on owning of Bitcoin, harvesting Bitcoin, anything having to do with the cryptocurrency. So could you walk us through the slow and sad breakup of the Communist Party and this magical currency, and where you see it playing out going forward?
Sure. I would actually start by going to set the stage for this story, to go back to 2002. In 2002, Tencent created what it called Qcoin, which was initially intended as, Chinese people didn't have credit cards. They were paying for all sorts of little things to Tencent. So Tencent provided games and all this. So maybe you'd use the coins to purchase items in a game. You would use it to maybe buy some little greeting card that you would send to someone with QQ and all this. And the idea was that people could buy these coins and then use them to transact in the games, and you didn't need to use the very clunky and expensive bank payment system for all of this. And Qcoin was very successful. Around 2007, it got to the point where other companies started to accept Qcoin, and even Taobao started to buy and sell Qcoin. And there were these gambling rings that built up around Qcoin, and the price started to fluctuate wildly. It started to become
gambling is illegal in China.
Yeah, gambling definitely illegal in China. So all sorts of illegal activity was going on. And Qcoin, which initially it was meant to be a fixed price, a certain amount of Qcoins equals 1 RMB, and it was supposed to be fixed. But in the secondary market, including over Taobao, which is run by Tencent's rival Alibaba, there were people buying and selling these at different prices, and the coin began to function almost like a separate currency. And there was a whole mania around people trying to buy up these coins, and the central government wasn't a fan, and they regulated it in 2009 and said you can only use these kind of virtual currencies created by gaming companies at the company who has created these tokens, and that ensures that this is not actually going to be a parallel currency. It's not going to be a separate payment system. It's just a way of it's like gift cards. Makes it much more you could say boring, because it's not actually a fluctuating parallel currency, and you see the exact same style of Chinese people's response and government response to that with Bitcoin, which is Bitcoin really begins to take off in China in 2013. Demand in China is a huge driver for the increase in the price of Bitcoin at this time, and the central government looks at that and says, we can't control this. We can't control Bitcoin. It looks like it's a way for people to get involved in all sorts of illegal stuff that we don't like, that they couldn't do without it. And we don't want a parallel currency operating in our country that we can't control. So in 2013, they already cracked down and said, this is a commodity. If you want to hold it yourself, you can, but we want to, you're not allowed to use it for payments. We don't want banks using it and all that. And it's just a way of nipping in the bud something that could potentially challenge their control over the monetary payment system and also financial stability. And so things cooled off quite a bit in this period. Exchanges continued to operate. The government for a while was trying to figure out how they can help the exchanges that allow people to buy and sell Bitcoin to comply with more of the anti-money laundering style regulations. But ultimately, with the rise of the initial coin offering craze, where people created new digital currencies like Bitcoin to raise money, they looked at just how rapidly this was developing in China and how many of these were likely to be frauds, and said this this looks like peer-to-peer lending all over again. This looks like a lot of frauds, and they decided to nip it in the bud and do an all-out ban, which is harsher than any government in the world has done on the initial coin offerings. And in addition to that, without even really having clear regulations in this area, they decided to also shut down the exchanges that allowed people to buy and sell Bitcoin. So you can still hold it, but it's very hard to get your hands on it in China now.
So we're talking. We've talked a little bit about the Chinese regulators sort of as a monolith. But I asked you a personal question about how these guys or guys and gals are overworked and underpaid. But could you give us a bit more of a human and a bureaucratic sense of what the main regulatory bodies are, who's staffing them, and kind of what their personal incentives are when it comes to dealing with all these sorts of internet finance issues?
Yeah, that's a big question. So the most important of all the actors is definitely the People's Bank of China, the central bank. And these people are generally viewed as being the most pro-reform market kind of bureaucracy within the Chinese government. They're concerned with the stability of the economy, the well-functioning payment system, and also with encouraging innovation and economic development. So at times, if you want to regulate more tightly to ensure that things are working with stability, you might lower innovation. And they've been at different times more or less encouraging of, quote, financial innovation based on how the kind of risks that they perceive versus the potential reward for the development of China's financial system. Then you have people like the banking regulator, the China Banking Regulatory Commission, or CBRC, and they're the main regulators for the more day-to-day type of supervision of the banks. But again, they are mostly creating policy in Beijing, and the people that implement that policy tend to be people in local finance offices in the cities. Those guys do the most of the dirty work of actually inspecting these companies and making sure they're complying with the rules that are laid down in more broad strokes from people in Beijing.
Well, I did throw a big one at you for your last question, but I think you handled it wonderfully. A final question on a bit of a happier note. So say you were to quit your policy analysis job today and wanted to join an internet finance company in China. Which one do you think is doing the most interesting stuff, and where do you think you could have the most fun in?
I think there are a lot of good options, but I would probably go with the leader, Alibaba, because they just have so much data, so much expertise, and although sometimes they get a bad rap, I think that they're doing really interesting work that is improving China's financial development and financial inclusion, and that would probably be a really fun learning experience.
Great, and with that, I think we'll call it an episode. Thanks so much, Martin. This was fantastic. Hope to have you on soon.
Yeah, thank you for having me.
2009年的某天，你诞生在这疯狂欢谈的世界，到处都被不同的中心牢牢控制。你的出现改变了世界，用你温暖开放的胸怀融化所有的墙，让人们自由。你的公平消除了所有的不平，你的坦诚击退了所有的质疑，你的透明让我们彼此相信，你的阳光照亮了我们的未来。比特币，比特币， 里注定你是个奇迹。比特币的比特币的比特币，神秘的比特币。比特币的比特币的比特币，世界从此因你变得更美丽。比特币的比特币的比特币 ，I love you 比特币。人们从此张开了笑颜，每份努力都有平等回报。人们只要简简单单的做他自己，不用再去拐弯抹角，不用再去唠唠叨叨，一切自由自在，自自然然。你的公平消除了所有的不平，你的坦诚击退了所有的质疑，你的透明让我们彼此相信，相信原来我们都是比特币。比特币的比特币的比特币，生来就已注定你是个奇迹。比特币的比特币的比特币，神秘的比特币。比特币的比特币的比特币，世界从此因你变得更美丽。比特币的比特币的比特币 ，We love you 比特币。比特币的比特币的比特币，比特夸克泽特来的未来币，还有数码狗狗无限世界币，我们都是比特币。比特币的比特币的比特币，比特币的比特币的比特币。比特币的比特币的比特币，我们都是比特币。比特币的比特币的比特币，比特币的比特币。